2021, the last show of October. Dr. Wald, it's good to have you on. How are you doing?
I'm very glad to be here and not in jury duty.
Oh, yeah, yeah. Well, I guess you were
I, g-
called.
I got excused. I got excused from jury duty.
Did they know that they were letting someone of your stature get away?
I don't know. I don't know, but whatever the reason, I got excused so I can be here with all of you lovely folks.
There we go. Okay. Well, we have a guest on today, so let's get into it. Um, right here with World Oil. Wall Street projects a higher for longer era for oil prices. Higher for longer. We had lower for longer not too long
Yes.
ago. Like that was not too long ago. Lower for
Yeah.
longer.
So I want to know what constitutes an era in oil prices? Like how
Mm,
long is an era?
I would say what 2 to 3 years. Like that's a
2 to
pretty
3
long
years.
time. I mean, I'm
Hmm.
just guessing. What do you think?
I don't know because we had lower for longer era would be what, like 6 years? Is that an era?
Mm, That's like that's like a
That's
eon.
yeah, I was gonna say,
I would
that's an
say it.
epoch.
Yeah, it has to be long enough to where it substantially changes how the industry is going, right? So
Yeah,
that's a couple years, I would think. So,
yeah.
if we were sub 50 for a year in the tech in the US side of things, it'd be bad, but it's not in the world. But if you were sub 50 for 3 years, that would just be like the apocalypse over here. So that would be long enough to really change it. That I guess. I don't know. I don't really have a good old
So
definition.
so I would say then that once we start seeing, um, more investment maybe
Mhm.
being put into big fossil fuel projects, that's when we've reached era status. That the industry is actually changing
Changing, yeah.
how it does business or in response to a new price situation.
Okay, speaking of that, I had a call this morning with a group that wants me to work with them, be on their board actually. Look at me. I know,
Ooh.
real fancy. Um, and they are in the carbon credit business. And their pitch is they've been in the oil and gas business for some time. And what they believe is that if you're, especially a small producer, mid to small producer, if you're not putting some kind of ESG carbon credit into your portfolio now, you're just going to draw on the vine. And so instead of fighting it, instead of trying to ignore it, if you want capital to come to you, go ahead and get on with the carbon credit system to attract capital.
So that's
We-
really interesting, and I'm curious because are we what kind of small company are they talking about? Small public companies or small private companies? Because I'm thinking that perhaps that there are definitely still plenty of like VCs out there who aren't really that are not ESG
Mhm.
VCs and so or whatnot. And so, you don't necessarily have to do this, but are they in the business of like making it more affordable for small companies? Because that's one of the big issues that I see is that like implementing these ESG strategies can be expensive depending on how
Mhm.
you do it.
No, oh, yeah, that's we didn't get into exactly all the different ways they're going to implement it. So I got some more follow up calls, but it was just interesting because he's like a third, fourth generation old guy, and he's like, we just can't get money, and to get money, we're going to have to do something. And so instead of trying to fight it, just go ahead and to work with it. It's not going
Embrace
anywhere.
it.
Yes, embrace it, embrace
Embrace
the
it.
ESG. And so,
Embrace
and then
ESG.
so I don't know. I thought it was interesting.
Yeah. No, it is interesting because if there is a way to make it more affordable or, because like one of the other issues it seems with like company with formulating an ESG strategy is that either you go with one of the big frameworks out there
Mhm.
or like you don't, and which none of which really matters because everyone has their own thing and does their own thing, and there's
Sure.
no standardization and there's no industry organizations that are offering any kind of standards. So like maybe there is an actual hole to be filled in this market by a company that says here, we can take care of your ESG needs um, you know in a cheaper fashion that is kind of standard for lots of little companies. I don't know.
Okay, so
It's interesting.
one more comment on this article, back to the
Yeah.
longer the higher for longer, sorry to derail us there. Yeah, this is from someone we've quoted before from Citigroup, Ed Morse. Morse, I can't remember how to say his name. Ed. Yeah,
Morse,
Morse.
Ed Morse.
Yeah, Morse. And this is from the article. It says not everyone supports the idea that prices can stay at elevated levels. Citigroup said in a report this month that crude below 30 and above 60
Hmm.
look unsustainable in the long term. A prolonged price above 50 could add 7 million barrels a day of the extra supply. The bank's analyst, including Ed Morse, wrote a note. He said, "quote Midterm cost indicators keep pointing to a fair value range between 40 and 55 a barrel."
So that's really interesting. I wonder where he sees those barrels coming from.
These guys that are gonna get
I
the
mean, this is
guys,
so prolonged price above $50. So we've been above that already for like half a year, right?
but not an era. We haven't been we haven't
Well, no, it's not an
under
era if they're not adding the barrels
right.
yet.
Yeah.
So, like, where are the barrels coming from? It's interesting because didn't Goldman Sachs just say they think we're heading to 90? Which
Mhm.
is like kind of a bandwagony thing to say when like Brent hit 86 today.
Mm,
Like, oh yeah, now we think 90.
right. I don't know, it's
Yeah, Goldman sees over 90. Okay, over 90.
yeah, I mean, that's could be by the end of this podcast. That's I mean, that's not really on the limb anymore. I mean, maybe it wouldn't happen, I don't know, but we'll see. I don't know, I mean, as the prices get higher, what is OPEC gonna do?
I
Because,
think, yeah.
I mean, if it goes over if we'll say let's say Brent crosses 90 for 6 straight months, just to put a number out there. What does OPEC do?
So I think that OPEC stays the course until I think OPEC stays its current course until at least until probably May or maybe April. Whenever their like deal thing expires, I think in May. So that would be like April, maybe before. That's when the gloves could all come off. UAE may be like, okay, we played along this far. Now we want to produce more. And I think that if OPEC sees that other OPEC, that not all OPEC countries will be able to increase production, and so if they have a good assessment of that and they see like, oh, hey, it's just going to be like Saudi, UAE, Iraq, maybe Iran. We still don't know what's going on with Iran, and like some Russia and some I don't know Guyana or I don't know whatever is Guyana in OPEC. I don't even know. They may decide, hey, let's go forward because there's not the same risk of like everyone producing, and so they're like, fine, prices might go down to like 60, but we'll still be making more because we'll be producing and selling more oil. But I do think that between now and that time, they seem very committed to keeping a lid on things because I think for a couple of reasons. One, they want to make money. They're
Mhm,
making a lot of money right now.
mhm,
And they are increasing production, so it's not like they're not making more money, but the prices are continuing to go up. So they've got that covered. They feel like they're justified because prices were so low for a long time.
mhm,
Plus, at this point, they're essentially, I mean, this is like a lesson to all of the like climate crazy people. They're like, you need us. You need fossil fuels. Maybe stop demonizing us so much. And I wouldn't be surprised if, especially knowing like Prince Abdulaziz, if he's happy to sit back and say, mm-hmm.
okay, so let
So
me
that's my read of the
okay.
situation right now.
No, that's a good read. Ryan's gonna put on Ryan's tinfoil hat time. Okay, Ryan's tinfoil hat time. Next year, for those who don't follow the news, is midterms.
Oh God. Oh God. You had to remind me. I'm, like, so happy in my,
I know,
like,
I'm sorry,
not super political bubble here.
very, very, very short time here. Midterms, so the Democrats will be doing what any administration would do, which is try to get the prices down going into midterms, right? Okay,
Prices of everything.
everything, not just oil and gas, everything.
Yeah, like Cheerios.
So will that factor into what OPEC does next year? Because if gasoline, I was talking to someone at church yesterday. He's like, "Man, I filled up the gas. It's crazy prices and all this stuff." And you're starting to hear people just kind of out and about talk about gasoline prices. That's
That's not
not a
good.
narrative that carries the midterms, right? Whatever side of the aisle you're on, it doesn't carry for you. So, what might we see with the
Yeah.
Biden administration pleading with OPEC to increase production?
Well, we know that they've been pleading. They were pleading with the oil companies in the U.S. To which they responded, "Haha, are you joking?" But a lot can change between now and November of 2022. I wouldn't be surprised to see a shift at some point this summer. I mean, that's a really good question. I'd love to get some, congressmen on to see what they think about prices, including energy prices
Oh,
for
yeah.
consumers.
Yeah, that's when it gets funny is when the elections are coming up, and if you're on the right and the left is kinda doing the thing to get the prices down, you actually have to go against that narrative because if it gets prices down, they might win or vice versa. So people, like, take all these weird positions because they wanna get reelected. They wanna get elected
Yeah.
more than anything else. So, uh
It's funny because I think we kind of have another article about this in a little bit, but they're saying that, yeah, there's a lot of like inflation and consumer prices are going up, but it's not stopping consumption right now.
mhm,
And so companies are just making a lot of money. But at some point, it is going to affect consumption. Like maybe it's not now just because everyone wants to get out and buy stuff, but it will. And the question is it going to do that in January? Is it going to do that in April? Like, how close to
mhm.
midterms is that going to happen?
Yeah, that's a good point. And this might be let's see here. Yeah, from CNN
Yeah.
Business. Nearly half of American companies say they are short on skilled workers. Um, okay. And you have
There's a bit more to it than that in
right,
this article,
right.
actually. No, what's interesting is so this is based on a National Association of Business Economics survey, and they found that nearly half of their respondents to their business condition survey reported a shortage of skilled workers in the third quarter. That's up from 32% in the second quarter, which was they thought was already high. No one thinks these labor shortages are going away, but what's interesting is that. Um, it says that um, that they think that this is going to translate into permanently higher business costs.
Okay, so let me give you an anecdotal story. An anecdotal story. I know someone whose job was they had to get the vaccine, right? Vaccine mandate requirement. They
Hmm.
weren't going to get it. They were kind of going back and forth, and then they got a substantial raise, and they got it. They got the vaccine and kept their job, or maybe they got I can't remember the order, but they got a raise after getting the mandate, right? So that cost of
Hmm.
that labor is now more expensive
Yeah.
in exchange for the vaccine, and that won't go back down anytime soon. And so I
Yeah.
don't know how many that's very anecdotal, that's one person. I have no idea if that's going on at scale, but I do wonder, are people getting incentivized financially to get the vaccine? And if so, that does raise the cost of things. It won't go back down.
Oh, totally. And then I think that it seems like part of the issue. And there's a really interesting article. I think it was on Yahoo News that I saw last week, which is basically some guy who had like worked in those, done a lot of work in service sector. Basically, was like he basically like spent a bunch of months like applying for just tons of jobs, like 96 jobs or something in Florida, all like kind of service sector jobs. And to see like, okay, what's going on with this? There's this narrative that everyone needs workers, and he only got like five like responses to all of the applications he submitted and one interview.
Wow.
And then when he went to there, he found out that like what they were advertising as pay was not actually what was being offered. And so to me, that says that yeah, there's like what we're calling a labor shortage, but it's not really a shortage. It's much more of a mismatch, and that either companies are not willing to pay people what the people are willing to work for, and so there's they're just not hiring people, and then there clearly are some companies who are willing to pay more to either hire or retain workers, and that is translating to the added cost. And the other companies have just found like, oh well, we don't care if we can't, open our McDonald's dining room because we don't have enough workers. We're just going to leave it closed because maybe it wasn't making that much money anyway. So they're willing to like say, fine, we'll pay less to hire fewer people. We'll keep more of the money, even if we make a little less money.
Yeah, I think that's part of it. And I also suspect listeners can write this down and berate me if they want to. That once high school ends in the summertime, so you have a fresh crop of seniors going to college. I wonder what happens then, right? Because that would be juniors, sophomores going to be juniors. They can now drive. So once you kind of have that transition where you have more people entering the potential, those low end jobs, workforce, do they pick those jobs up or not? And so, right, because all those sophomores that become juniors, a lot of those are who's picking up these dining room jobs at McDonald's.
Yeah.
And if they don't, then there's something else. There's something else going on. To your point, which is they're making more money by not opening it back up.
Yeah, and I wonder. I think that's why I think there's a lot of forces going on here, and just lumping it all as labor shortage is really not the right descriptor and not an accurate depiction of like what's out. It's like people are like the supply chain issues, and then you go and you read this article and you're like, well, it turns out that like it seems what the actual supply chain issues are is the inability to remove old containers from ports because of some regulation in California that prevents like truck yards from storing unused containers. And so if they can get rid of the containers that have nothing in them, they can't bring
Mhm,
in full containers.
mhm.
So it's like, and you realize like, okay, so that's the bottleneck. It's not just like the supply chain is messed up. It's like here's a specific problem, you know.
Yeah,
What do you think? Are they going to solve all the supply chain problems by sending ships through the Panama Canal to the Jacksonville port?
hey, Jacksonville's gonna be booming for too long.
Jacksonville is booming. Like, I mean, you drive around here, like in the slightly like south of here, and I've never seen so much construction.
Okay, well, let's go to our next article. I think our guest is still a few minutes out, so let's get to this one. Solar and wind force poverty on Africa. Well, Dr. Wald, if you wanted to get controversial, you picked the right article to do that. At least the right headline. So, okay,
Yeah.
let's hear it.
Well, I think it's a really interesting op-ed actually, in the Wall Street Journal.
Mhm.
I'm looking for it. I can't seem to find it.
Well, I mean, this opening line right here: Africa
Yeah.
can't sacrifice its future prosperity for Western climate goals. Thank you. You can get an amen from me. Amen. I will say the rooms that I get to be a part of with various ambassadors and dignitaries and stuff. This is the sentiment. Okay,
Yeah.
it's not that they're not against solar and wind per se. They're not. They're just kind of agnostic. But they also realize that couple things here. One, you're seeing soaring oil prices, and you're telling Africa, "Hey, no, 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 no. That age has moved on. You guys can't use that to generate wealth like the rest of the West in the Middle East has. You've missed that time." Um, and so
Can you think of anything more like post-imperial, like more like
oh
neo-imperialist?
no, it's the worst. It's the absolute worst. And so there's plenty of folks in Africa who aren't buying that narrative, and that's good because say it once, say it 100 times. I don't care about solar, wind, or whatever. Whatever works, works. But that's not as simple as just, there's not a one size fit all. But all these countries in Africa who are finding reserves and trying to figure out how to use the reserves to cut them off now would seem to be probably the worst thing imaginable. And I will say this to my folks over in Africa. I said it on this podcast, I'll say it again. If you want to generate real wealth in your country, give the mineral rights to the people so everyone can participate in the wealth building that you're going to see. So don't say you're pro oil and gas and then keep it all to yourself.
Mhm.
Give it back to the people, let them have mineral rights, and they will prosper just like you will. And they'll stick up for it far. I mean, it's a lot harder to tell a local farmer in Africa that you can't drill because of some Western climate goal than it is some head of state in Africa. So I'll stop my rant there.
No, that's that rant. I think really says it all. I have one thing I would add is that I do think that OPEC and OPEC producers, or at least OPEC as an organization, is very sympathetic to
Yeah,
this.
sure.
So yeah,
And that's the thing though, right? So if OPEC um convinces these African nations to join, then you will have plenty of them will sign up. And there's a book I've got somewhere. I'm trying to find it on this issue. But anyways, and the author argues that these African nations should join OPEC because of the access to data and all the stuff they get. My only concern is give the minerals to the people because we talk about Venezuela all the time, or we used to, and you talk about all the money's wasted, lost. The people never owned any of that, and so
yeah,
they were just taken advantage of.
yeah.
Okay. Let's see here. Tesla. We haven't done a Tesla article in I don't know how long. So it's good to see it. Tesla
Yes.
briefly hits 1 trillion market cap for the first time after Hertz says it will buy 100,000 electric vehicles. Okay.
So yeah, so like at first I was like, seriously, a rental car company is gonna buy a bunch of Teslas, and in part like maybe to help Hertz because remember they went under I think during the
Yeah,
pandemic.
bankrupt. Yep.
But yeah, this is a year after they filed for bankruptcy
Mhm.
protection. So, but then I thought about it and I think this was a brilliant idea because first of all, rental car companies don't actually like keep their vehicles for that long. So they don't have to worry about the like battery degradation or anything because they're just gonna get rid of them or sell them used and whatnot.
Mhm.
And like it's a great like advertising point. Like want to drive a test. Like say you're like
Oh,
going
yeah.
to California for vacation. Like hey, you get the full California experience.
Did you read the Hertz
Rent a
press release?
Tesla.
Did you read the Hertz press release?
I didn't. Did
Okay.
I? Does it sound like I wrote it?
No, you're gonna miss here. I mean, you missed out. This is the press release starting here. As consumer interest in electric vehicles skyrockets, Hertz today is announcing a significant investment to offer the largest EV rental fleet in North America and one of the largest in the world. This includes an initial order of 100,000 Teslas by the end of 2022 and new EV charging infrastructure across the company's global operations. And they've got a link to the release. The next paragraph. In addition, Hertz is teaming up with seven-time Super Bowl champion and entrepreneur Tom Brady. So,
Shoot.
they have
Well, there goes my chances of renting a Tesla from Hertz. Oh,
it's just it's just funny, like, instead of pounding home the Tesla, they drop the Tom Brady line in
and
the
Tom
second
Brady.
paragraph.
Tesla plus Tom Brady will actually drive up in the Tesla that you're renting.
Oh, that's hilarious. That's hilarious. Who
No, I
was,
made that up.
wasn't OJ a Hertz guy back in the day?
I don't know.
Yeah,
Maybe.
he was one of
Uh,
those rental companies. He was big ad person, former spokesperson. So the slogan is Hertz, let's go with Tom Brady.
until the battery runs out.
That's gonna move them. Yeah, that's gonna move a lot of vehicles right there.
Yeah.
Oh,
God.
gracious. Briefly, so 1 trillion. There you go, Tesla.
Yeah.
Okay.
Then it
All
went
right.
down.
Let's see here. We got time for one more. Ahead of COP26, Saudi is it COP or do you call it
People
COP?
all call it cop, so
COP?
we can call
I
it
don't like
cop.
calling it COP. I
I
don't like calling
know.
it COP. I've heard people say that. I'm like, COP. Ahead of COP
I don't
26,
even know what does it stand for.
corrupt, obvious politicians. I don't know. Ahead of COP26, Saudi Arabia resists calls to cut oil investment. Good for them.
Obviously.
That was my editorial right there at the end.
Yeah.
I mean,
They're like, we're going net zero by 2060, and yeah, we're not stopping to invest in. We're going to keep investing in fossil fuels.
well, why would they stop?
I know. Why would they? They're like, you guys obviously need it. We produce it. We want to sell it to you. Like, obviously, yeah. It's like an invest. Here's what Abdulaziz bin Salman said. He is pushing the argument that such a rigid zero investment target for new oil and gas development would reduce supply before global demand drops significantly, risking an oil price super spike, according to people familiar with the talks. Forget super spike, risking like global blackout. An investment ban isn't fair to economies that are overly dependent on importing or exporting oil and gas, these people say. I love how they're these people. How about like people with common sense? This has to do with the UN's Intergovernmental Panel on Climate Change because they're trying to make this report that basically says we need to stop investing in fossil fuels. And the Saudis are like, yeah, get rid of that language. But the Saudis aren't the only country saying this. So's India, because it's also producers that don't. I mean, it's also
Mhm,
consumers that consuming nations
mhm.
that import a lot that don't want to, that don't want this language because they don't want the oil that they need to import to be $200 a barrel. So, I mean, it makes a lot of sense. It's just it's just like so I don't know, it just seems so ridiculous. It's like they're all like, we have to stop investing, and yet when push comes to shove, everyone wants it, and then they get upset that the prices are too high. So I don't know.
Well,
There has to be. I don't understand why instead of saying stop investing in oil and gas, why don't they just say put more investment into nuclear or whatever it is that you want, and stop demonizing any one like fuel and just promote the better ones because we're going to need more.
that message is not Greta approved for one. Um, the listening audience just missed your reaction, and so that was I enjoyed that. But
Greta approved.
but two, um, oh gosh, you made me forget what I was gonna say. Oh yeah, so you take somewhere like India, which we've talked about before, has some of the highest, or maybe the highest gasoline prices in the world. Okay, so if you cut production, those people who need those gas powered vehicles, their gas prices go up exponentially. And so another thing is could somewhere like India actually handle a massive transition to EVs with their grid capacity? I don't think so.
I don't think so either. I don't think anyone can really handle that massive a capacity jump for EVs.
What I don't understand is when we sit here right now and you talk about the fear of the shortage with the folks over in Europe, going through what went through in Texas, it feels like we should be focusing on making sure our baseload capacity is actually like there's not a lot of talk about that, despite what we've seen in the rhetoric that we hear on a daily basis.
Do you think these people even know what baseload, like, know the term baseload?
No, probably
Yeah.
not, probably not.
See, if you don't know what the term baseload is, I'm really not sure you should be making policy like this.
Well, you have to remember the mayor's daughter was having dreams about 9/11 and nuclear plants, remember?
Oh yeah, right. So that's the big deal. Yep.
That's the big deal. Okay, well, Dr. Wald, we have a guest who allegedly is coming on the podcast, and so assuming they will
Hmm.
be here in a second. If not, let's go ahead and talk about where we will be this week.
Where will we be this week? That is a good question. Let's see. I was on Bloomberg TV today discussing some energy crisis and oil price issues. I will be on investing.com later this week. And that's all I have planned so far.
Let me see here. I have this week coming out. Oh, former MMA fighter and champion John Fitch talking about what it's like to be a professional fighter. So, Dr. Wald, what else did you want to get to today that we didn't touch on already?
Um, I did think that we could discuss a little bit of what was it that I wanted to discuss? Um, there was an interesting article about ESG that I kind of wanted to talk about. Here we go. BlackRock's. This is a good one. Here, BlackRock's wish is your command. But since we already had an op-ed from the Wall Street Journal, I didn't pick this, but I'm going to send it right over to you because this is a good one. Basically, the idea is that the Lords of Finance, this is an editorial, the Lords of Finance now want the SEC to coerce even private companies with their ESG agenda. So I don't know how many people know this, but right now the SEC, not the football people, the Securities and Exchange people, are be really interesting if they got the football people, on this. But
Yeah.
so they are considering some rules, doing some rulemaking about that would affect disclosures in the ESG sphere. And generally, like, there's basically like no oversight on this. It's all voluntary reporting. It's not something that the SEC has really gotten into, but they are wading into this realm now. And apparently, BlackRock. So that but these disclosures would only apply to publicly traded companies. But now BlackRock apparently wants the SEC to regulate um, private companies. So BlackRock CEOs threatened to vote against director slates of companies that don't comply with the Sustainability Accounting Standards Board's environmental, social, and governance disclosures. So not only is he saying they have to do this, but he picked which like there's a bunch of these different like
Mhm.
frameworks that you can. He's picked his, and he wants the Michael Bloomberg one.
Well, of
So
course.
they have to comply with that. Um, and NASDAQ is requiring companies that list on its exchange to include two, quote, diverse board members or explain why not. So yeah, so that's kind of interesting.
Okay, I
Um,
think our guest is here in the green room.
Excellent.
We'll bring him on. Rhett, can you hear us?
I sure can. Can you hear me?
Yes, sir. Okay, well, good. We thought for a second there we weren't gonna get you on today. It's good to have you. How you doing?
I'm good. I'm good. You got my audio, my video feed there?
No, we just have your audio.
Okay. All right. Fair enough.
Okay, so give everyone maybe a quick introduction of who you are and what you guys do.
Yeah, certainly. So Rhett Bennett, founder and CEO of Black Mountain, started the company back in 2007. Over the last 14 years, we've built 9 different businesses. So really entrepreneurial, very dynamic. So we've done upstream E&P, frac sand mining, mineral royalty, solid disposal, midstream, battery metals. So everything's kind of within natural resources, but really just opportunistic and like building teams, kind of creating companies, and that's kind of our core strength.
Sounds terrific. I was I had a bunch of interesting questions about some of your resource interests, both in Australia. But let's start a little closer to home. I can see from some of the material you sent that you guys do a lot of work both in Texas and Oklahoma, in the Permian, and the Barnett, and the Eagle Ford, and also in Williston. And we're curious to see what's your take on kind of the drilling situation, the labor situation, the material situation going on right now in these areas?
Sure. Yeah. I would liken it to a train that all of a sudden is, started again, and you're really starting to see all the cars down the track kind of kink and jerk, and you're really, you've got real issues from a labor perspective. I think that's prevalent across the whole patch, regardless of state. So whether you want to say in the Permian, where labor is always a bit of an issue, but certainly Eagle Ford and some of your Rockies basins as well. So labor is definitely an issue. You're hearing it on the drilling side as well, with some of the consumables. So yeah, I think like the rest of the global economy is experiencing, like you're having some real supply chain issues, which were probably exacerbated for our industry just with the severity of the downturn, which negative pricing will tend to do that. So yeah, it's a real issue out there.
Just out of curiosity, what do you find maybe is the most challenging? Because we were talking earlier on the podcast about how these terms like supply chain issues or labor
Yeah.
shortage get thrown around, and then but it turns out there are like we're kind of wondering, well, how do we dig down and see like what are the issues? Are materials costing more? Are people not available at the right places? What's are there a lack of truckers? Or we're kind of curious, what are some of the issues, and do you see them starting to resolve at any point? Because we've seen a lot of it's very, I would say that there's been some negative impressions that U.S. drilling is never going to come back the way it was, and then on the other side, we've heard people say, well, it is going to pick up. Where do you fall on that side?
Yeah.
on that
So
debate?
sure. No, happy to opine. So I would think the starting at a high level, the pivot to energy transition and just kind of the total abandonment of traditional energy was premature. Certainly energy transition occurs, but I think in the same breath, we probably all need to admit it's probably going to take 20, 30 years. So there's a lot of aspirations to be all electric by 2025 or 2030. Physically, that's not realistic. And we know that we've got a battery metals business. So we know the fundamentals and the supply and demand picture on nickel, copper, et cetera, and all the forward facing metals out there don't exist in the quantity that would help you achieve those targets and aspirations. So starting with that, like that's that's a real thing. And so bringing that back to the oil patch, I mean, I think higher prices are, I think they've already surprised people where we've gotten to, but even higher prices are coming. I would say absent a global recession, you're certainly going to see oil over 100. You'll see gas with a 6 handle again this winter, like really robust pricing relative to what the industry's been able to experience for several years. So ultimately, that drives activity higher. The siren song of high returns are just going to be too irresistible. I mean, at these prices, a Hainesville well pays out in 90 days. I mean, if you are a private guy, you're drilling that well all day long. Now, the publics have some constraints in regards to reinvestment rates and really what the market wants to see or, really doesn't want to see from a growth perspective. So there'll be a bit of a governor on activity in that regard. But if you're private, it's a beautiful scenario where actual inputs on the cost side of the ledger haven't risen near as much in lockstep with what the revenue side of the ledger is on just what oil and gas prices are. So returns are going to drive activity. It'll be back. We could debate, does it hit peak levels or not? I think ultimately the industry is more efficient after every one of these cycles, and so you could argue rig count won't hit the same level, but I think activity and potential productivity is on par with what you've seen in previous cycles.
Let's go back to what you said there a second ago. What did you say about Hainesville Wells? Did you say they pay for themselves in 90 days?
Oh, at these gas prices, absolutely.
Okay. Those Hainesville Wells are pretty dry, right? There's not a whole lot else there, so it's not like they're getting the benefit of oil. So what does that say about Permian wells?
Yeah, well, so Hainesville Wells at an IP of 30, 35, 40 million a day in gas. If you are at these kind of gas prices, where you've got a 5 handle, just the economics are off the charts. Now, your Permian wells are more oil weighted. I mean, we're looking at acquisitions out there, and you run your price decks, and a lot of Wolfcamp A, Wolfcamp XY, or second bone, third bone all have 120 to 180% RRs. I mean, so you're talking a lot of inventory exists in the U.S. at this point with under a 1 year payout like that. And again, back to just the reason we had the last crash is just, we are a capitalist society with no restraints that you would find in an OPEC style situation. So I can tell you as a private capitalist, if I can go make an investment and get a 1 year payout, I'm going to go do it. So that's where I just think activity does kind of come back, but we're a cyclical business. And so that activity does at some point influence pricing, and you have another cycle. So.
Yeah, another thing you mentioned about the labor and the prices for materials. So, kind of unpack these three buckets. We have high prices, okay. We have some labor constraints, but then material costs are up. So, what does that mean for what we should expect to see producers? Should we expect them to see better margins, or the material cost offset the constraint they're seeing with labor?
Yeah, so I think what you'll see when you see 2022 budgets. I think a lot of E&Ps are going to want to increase their activity 15 or 20%, increase their budgets that much to accomplish a little more activity at these prices. And I'm thinking of the publics through this lens. But what I think you'll quickly find are actual 2022 kind of volume projections actually fall short, because I do think you'll see some cost inflation. So even as they're increasing budgets, a lot of that probably will finally get consumed, where you start to have some inflationary pressures on your costs and inputs. So I don't think everybody hits their production targets next year, even though they thought they would by increasing their budgets. But the lion's share, and so we launched a SPAC, a special purpose acquisition corporation, last week. It is mainly focused on upstream assets, and to me, I think that's where really the bulk of the profitability will be, kind of this part of the upcycle, and that, like oil prices ran from 40 to 80, and frankly, the E&Ps did a better job consolidating in the downturn than a lot of the service industry. So you come into the upcycle, prices have doubled, service costs have not doubled. There's still too much competition out there. So you really, to me, a lot of the benefits of the upcycle at this point are going to be accruing to the E&P operators. So we think they're going to be just wildly more profitable than they've ever been. So we like that aspect of the the oil and gas universe, if you will.
How do you think OPEC is going to react to all of this? I mean, it seems like OPEC's worst nightmare.
Yeah. High prices tend to cure high prices. Yeah, at a certain point, they probably think it's not in their best interest to see $100 oil. Certainly not sustained $100 oil. But what I would say is a bit of the price run we're having. That cake was baked during the downturn. You saw just such dramatic reduction in activity. Capital starvation has consequences, and so you're seeing the fruits of that, and you're reaping what you're sowing. And yeah, so you're really hitting a point where you're just not going to catch up fast enough, because shale's a treadmill, and if you hop off, you're looking at 50, 60, 70% decline rate. So you really have to keep reinvesting in those businesses to hold flat or grow production. And look, Wall Street really mandated, like, hey, growth is over. We want to see dividends. We want to see deleveraging occur. And we're doing all that. But in the background, supply is diminishing while demand's recovering. And therein lies the, kind of the price run.
Go ahead, Ellen.
Oh, well, I was going to turn to a different subject. So do you want to talk more about this?
Yeah. One more question on this, and we'll change. I was saying at the start of the show, I had a group reach out to me about being on the board for some carbon credits, and their thesis is that they're long-term oil and gas. They've been oil and gas. They want to stay in oil and gas, but their thesis is to get capital back into the industry. Producers, by and large, have to go ahead and embrace the ESG carbon credit model to get the investors to come. If they don't do that, they're going to basically die on the vine. What are your thoughts on that?
Yeah, carbon absolutely is going to have a cost, and whether that manifests itself through a carbon tax or just the requirement that you need to do offsets, totally coming. And so you do want to be leaning into that and thinking about the future. We're spending a lot of time at Black Mountain around that. We've got a separate carbon lock venture that really is focused on that. And it's going to be a big business. I think those winds are blowing in that direction. I think it creates an opportunity for the industry. I mean, if you think about, sequestration or some type of, carbon mitigation, some of it's nature-based solutions, but really the most, bankable is underground sequestration. It's basically permanent removal, whereas nature-based solutions are a little more like rentals. Like ultimately that tree dies and decomposes, so it's not, it's not like a permanent offset. And so in that regard, who better to kind of lead a underground sequestration, growth industry than the guys that have been doing it in CO2 floods, for 50 years. And we know a lot about drilling wells, reservoirs, injection. It's just a very logical energy transition thematic for oil and gas guys to have really relevant competencies. So totally think it's coming, and I totally think the oil and gas industry should be a part of it.
Yeah, that actually leads right into where I wanted to go, which was I wanted to talk about the direct air carbon capture plant in Australia. And to me, it seems it's interesting. I was kind of curious how you clearly see that as a carbon tax in the United States inevitable. Is it coming? Is this how you as a company are preparing for it? And do you see a carbon capture and sequestration as economically viable without some kind of carbon tax legislation in the U.S.?
Yeah, as it stands today, if you're really going to do CCUS, underground sequestration, you've got a revenue stack and take advantage of whether it's California's LCFS or the 45Q. You're really building towards that. And I think at some point you have to just take a position. Do you think the cost of carbon's going up or down, and in most markets continues to kind of go up and to the right. So I think all that's coming. I think as we kind of survey the landscape, and we've got an E&P asset within Australia, Australia is really endowed with a lot of natural resources slash interesting advantages when it comes to that. So we were really quite focused on the sequestration capacities that exist in country down there. Really liked the technology and the model that Carbon Engineering had put together. So we spent a lot of time with those guys. Been to Vancouver, seen the pilot plant, and really kind of understand what goes into that. And yeah, I think you'll hit a point where carbon is a export ability, just like oil and gas is kind of on the input side. And by that I mean there's a lot of countries in the world where you really don't have good sedimentary basins where you can do sequestration, and so having the ability to mitigate and basically inject and store carbon can be a real export business for companies in other countries that really need to get those offsets or mitigate their footprint. So it's really interesting kind of watching where that's going to evolve over time. And just like the US or Australia or other countries were blessed with hydrocarbon bearing basins, the same can be said in reverse, and that you're really going to have the ability to mitigate and long-term sequester carbon in specific countries. That could really be something that's a export commodity, if you will.
It's really interesting.
Yep. I think we got time for one more, Dr. Wald. I got one, or do you got one? Go ahead.
Why don't you go, because I asked most of the questions.
That's fine. You mentioned earlier forward-looking for battery technology. We hear a lot about China's potential grip on the rare earth minerals. We talk on this podcast a lot about can the grid actually uphold it. Give us where you think the state of battery technology is, and what are some of the problems that have to be resolved in the next 3 to 5 years?
Sure. Yeah. So from my perspective, there's no problem with battery technology as it exists today. Certainly competitive with ICE, with internal combustion engines. The biggest problem is going to be the supply chain and raw materials. And so as we've looked at the space, you've really got a lot of aspirations on how many gigafactories companies are competing to build, to really invest in the manufacturing capacity of electric vehicles. And there's little to no thought about where those gigafactories are going to source the materials to build their car batteries. And so that to me is going to be the biggest governor on energy transition. It's just a lack of actual materials to accomplish the feat. And so to put in perspective, and kind of copper's a great example, but over this decade, you'll really need to bring online, depending on your pace of adoption assumptions, anywhere from 6 to 8 million tons per annum of copper production. That's a huge task to put to humanity. And so to put into context, Escondido is the largest copper mine in the world, produces approximately 1 million tons per annum of copper. What you're really telling the world to do is to go find the largest copper mine ever discovered and bring one of those online every 18 months for the rest of the decade. Like, it's just not going to happen. And so when you start to think about like, what are the constraints to actually going electric as a world, it actually really starts with battery metals. And there's a real lack of investment in that part of the supply chain versus the downstream stuff that's more techy and a bit more, kind of interesting for capital to wrap their heads around. But we've kind of heard it eloquently put, but this decade's really going to be, the revenge of the miners. And it's going to be an area where just like oil and gas right now is currently suffering from capital starvation. Metals and mining has had that for, close to a decade now. And when you juxtapose that with kind of the EV thematic and the pure growth that you want it to have, the average mine takes 7 years to go from discovery to production. Like, it's not near as nimble or responsive as shale is. Like, we could add 1 million barrels of oil production in a year if you give us the right price signals. So it's just, there's a real disconnect there that's going to play out over this decade. I think it's great for the battery metals guys. I think it's great for the oil and gas guys because that lack of reinvestment is going to lead to sticky higher prices. So that's my review on those.
It's funny to hear you say that because a lot of the Western African nations I talk to, they are always pumping these mining projects, and they're pleading with folks to come over there and invest and to start these projects because they are a long lead time, as you say. So, okay, where can people find out more about you or your company? Where do you want to send them to?
Yeah, I think just our websites, www.blackmtn.com. So MTN, like short for mountain. Probably best to guide people there. And yeah, appreciate you guys having me on.
All right. Thank you so much for your time.
Also, you can follow them on Twitter.
There you go.
Yeah, right.
Yep. Okay. All right, Brett, thank you so much for coming on.
Okay. Thank you, guys.
All right, Dr. Wald. I think I called him Brett there at the end. Rhett is what I meant to say. So sorry. Apologies to the good folks at Black Mountain. Okay. I think we've hit everything. Where we're going to be, what's going up. We'll be back next week, right?
Sounds good.
All right, listeners, thank you so much for tuning in, and we'll talk to you then.